Hey folks, welcome to a brand new episode of Smart Money. Now last week we kick-started a two-part series to understand and dive deep into the futures and options space. Last week was all about talking about the jargon, demystifying, decoding, all of that. But today, the episode is a masterclass on not just the futures and options space, but we'll help you understand how to read and interpret the futures and options data. And the guest on my show today is independent market expert Siddarth Bhamre, a man who is an expert at his craft and someone who I think has over decades of experience in trading in the derivatives market. Siddarth, we're speaking to you after a really long time, so welcome to Smart Money. Thank you so much for being with us and good seeing you.
Thank you so much, Sonia, and it's a pleasure to be on your show. And hopefully, we can demystify, as you're saying, some of the doubts which your audiences have.
Absolutely.
And let's try to add some value to their understanding.
Absolutely, and this is a space and this is a segment that everyone wants to sort of get to know about, but no one knows anything. So let's start with options, right? Because the market, Siddarth, has the options market, that is, has a lion's share in the total volume pie. But when it actually comes to understanding, it lies at the absolute bottom of the pyramid. So can you explain first up how option prices are actually determined?
So option pricing we'll get into, Sonia. As you rightly mentioned, lion's share, that is more than 80 to 90% of total turnover is option turnover. But when it comes to understanding of this subject, there is a scarcity. So let's visit some basics. There's no harm in revisiting some basics. Let's understand how options are priced. Now there are four important factors. The first factor which everyone should know is what happens when the underlying prices move. And before we step into that, I want to highlight what is direct correlation and indirect or inverse correlation. If milk price goes up, so would curd price go up. Milk price goes down, curd price goes down. That's a direct correlation. If a supply of a product goes up, the prices would come down. And if supply comes down, prices goes up. This is inverse correlation. You need to know this basic. Now coming to the call and put, how price of an underlying changes the premium of call and put. So with calls, it is direct correlation. If prices goes up, say ITC, if prices are going up, the call price for ITC will go up. And if it comes down, the prices of calls would come down. It's opposite for put. If put prices, if the ITC price is coming down, then the value of put will increase. And if it's going up, then value of put will decrease. So this is very simple, and I'm sure a lot of people know about this. The other factor which I want to talk is about time. Now, say Nifty. When is the probability of Nifty going high, say by 10%? In a week it's high, or in a month? Answer to that is in a month, right? So what we are trying to say over here is, higher the time you give for certain underlying to move, better are the chances that you can make money. So more the time, more the premium. Now, if I'm not wrong, Bank Nifty, there are quarterly options which are going to come. So you always see that weekly premiums are less, monthly premiums are high, and now quarterly or yearly premiums for Nifty would be much higher. Higher the time, higher the premium. The third aspect, and it's a very important aspect, and let me say one thing before this, that in market, wherever the probability of making money is high, things will be expensive. And wherever the probability of making money is low, things would look cheap. The third very important factor, Sonia, is volatility. Case in point, let's consider two stocks.
Okay.
Hindustan Unilever and India Bull Housing Finance. Now, which of these two stocks can give you a 10% move faster on the either side?
Okay, I think it's India Bull Housing Finance,
has to be
right?
India Bull Finance, right? Yeah. So if the probability of that stock of moving up or down by 10% is higher than, say, HUL, then obviously I will charge you more for call or put. So irrespective of whether it is call or put, if an underlying is more volatile, then more premium has to pay, because your probability of making money or losing money on the other side has increased. And the other factor is the strike price. In last episode, you have discussed very nicely that what are strike prices and how one should look at it. Higher the difference of strike price or higher the gap between strike price and current market price, lesser is the premium.
Okay.
Case in point, Reliance, say Reliance is trading around 2,000 rupees. You have expiry on 29th of November and 2,500 call option is trading at say around 5 rupees. It's 25% away from here. How many times Reliance has given a 25% move in 1 month? Very less.
Yeah.
Very, very less. So that's the reason you have premium of 5 rupees. Now you multiply it by lot size is 505, you get around 2,500, your margin money is 2,50,000. So what you're making 1% on 2,50,000 rupees.
Okay.
So this is how, option prices are determined. 4 factors. Now, very important over here, Sonia, that without touching jargons like delta, theta, vega, we have explained everything.
Okay, so you told us about the 4 factors, right?
It is delta.
Sure. You spoke about the different factors, and I think you explained that really well to us. The volatility, the strike price, the price itself, and time as well, the amount of time. But for every underlying option, there are so many different options to choose from, right? So how should one really determine which option does one choose?
So if we look at option chain, and I'm sure a lot of traders, investors, they would be going on NSE or BSE website and they'll be seeing option chain for an underlying. So it completely depends on what view you have, what kind of risk appetite you have, and what is the time horizon which you have your view for. Let's look at a call option chain. And for simplicity of calculation, let's discuss some underlying which has 1,000 rupees as a base price. So on your screen, we can right now show that a call option chain where current price is 1,000 rupees and look at the different strike prices below and above. So we have 1,000, 1,050, 1,100. We have strike price like 950, 900. Now at the monies when strike price and price of the underlying is same, which is 1,000. More higher you go, that is out of money, the premium reduces, as you can see on your screen. And in the monies, deep in the money, which is like around 900 price, where premium is around 120. Now let's understand the sensitivity. What is sensitivity? Now here I want to take a very basic example, Sonia. Suppose you know how to ride a cycle and you are on a decline. One pedal on a decline and you can go a long distance or you can cover more distance. If it's a flat surface, then you cover say X amount of distance, which is less than what you could have done in descent. And when it's inclined, in one pedal you can hardly cover any distance. Similarly is the case if the underlying moves say 1% up. So a 1,000 rupees underlying becomes say 1,010. So an at the money option, what example, this is a hypothetical example we have taken, say it moves by 50% of the underlying price movement. So underlying price movement was 10 rupees. 10 rupees is 1% of 1,000. Okay. So at the money option will move 50%, that is 5 rupees. So existing premium was 55. 55 plus 10% of 55, that is the premium which you'll get. Okay. If you look at in the money, then in the money would be 120 plus 80%. So this is how prices move. In the money would move higher, at the money would move bit less, and very less move would come in out of money option.
So Siddarth, let me just
upon your risk appetite, depending upon your.
Let me just interrupt you here because we have this full graph on the screen. So you're saying that there are different strike prices that you can select, and depending on the strike price that you select, so there is 1,000 is the base, then there's an 1,100, there's a 900. Depending on the strike price that you select, you sort of have your chances of profitability. Now, we're getting a couple of queries that are coming in live on our Twitter feed as well. So let me just pick up a couple of them. Deepak Chaudhary writes into us, which strike price should be selected for better chance of profits? In fact, Anand Sodhani also writes into us how to pick the right strike price and what factor to keep in mind while choosing the option strategy. So just giving us that same example back, can you tell us how does one really pick the right strike price?
So if your time horizon is say 1 month, then you can afford to take chances of taking an out of money strike price where your investment is less. If your time horizon is very less and you don't want much of risk to be taken and you are quite confident about the direction and direction is not huge, then it is better you take slight in the money strike price. Say here you can take 950 or you can take at the money also 1000 strike price. More in the money, the reflection of the premium would be like futures. More out of money, the movement would be less. So it completely depends on the time horizon, how strong your view is, and how fast you are expecting it to move.
Okay, all right. So can you give us like some real-time examples? You know, we'll do one thing. We've sort of understood a lot about the option pricing and how to pick the right strike price. We have many more questions for you, but we need to slip into a short break. So guys, don't go anywhere. We'll be back. We're getting a lot of your queries as well. Keep them coming and do come back. Smart Money returns in just a bit. Welcome back. You're still watching Smart Money on CNBC-TV18. We've picked up a very technical topic, which is the futures and options space. We're trying to give you a masterclass on that. And Siddarth Bhamre, who has been a master in this space for a long time, is trying to sort of, you know, explain to our viewers option pricing, how to pick the right strike price. Siddarth, it's a lot to digest, right? So one question that I had before taking up all of our viewer queries is that, you know, every contract has two parties, right? A buyer and a seller. But we still keep hearing jargons like longs formed, shorts formed. Why is that so? Can you explain that to us? Also, in options, how would one understand whether the open interest built up is long or short?
So this is very basic question, Sonia, and most of the people have this, that if contract has two parties, then why you give weightage to one and not to another? For every buyer, there is a seller. So this world rewards to winners. It doesn't, you know, care about what losers are doing. And that's what we do in futures and options segment also. So yes, for every contract, there's buyer and seller. Let's consider all four examples that why we call long formation, short covering, unwinding of positions. So first case is long formation. So if people are buying, their open interest is increasing, and if more people are buying, then prices are going higher. So those who are long are making money, and that's the reason we are giving weightage to people who are making money. That is formation of long position. When people are selling and open interest is going higher, people who have gone short are making money, and we give weightage to them. That's formation of short positions. So this is very simple to understand. The other two are also not very difficult. Suppose you have gone long, say in stock Infosys, and now that stock has gone up by 5% and you decide to book profit, what you will do to your position? You will sell it, right? You have bought, so now you're selling it. And if you sell it, the prices would come down. Say you and a lot of people are doing that way. And the open interest will also reduce. So it is long unwinding. What is short covering? And this is most widely used term in market. Whenever market goes up, people keep on saying that this is short covering. That's not necessarily always true. You need to see the data. If people have gone short and now underlyings have corrected, and now they feel that they want to book profit because say underlying has come on support or news is positive, then they square off their short position. To square off a short position, you need to buy. And that is why the prices go up. And this is short covering. One point I want to add over here is that if any underlying is in a rising trend, and if some correction happens because of long unwinding, you should not change your view, because it is just profit booking and probably trend would resume. And similarly, it goes to if there is a bounce back which is happening because of short covering, don't get carried away and say that bottom formation is done. It is quite possible that it is just a short covering and the downward trend would resume again. So this is how you interpret futures data.
I have one query there. I have one query there. If we can just go back to the previous plate. So you said that short covering, you shouldn't interpret that if a if a stock sort of moves up because of short covering, it's on an upward trajectory. But what if short covering happens for like 2-3 days on the trot? At what point do you realize that the trend for that stock has changed?
Very smart question, Sonia, over here. You need to follow up data. So suppose there is a increase of 50% in open interest when stock was coming down. So those positions are there. Now they are covering. But when they are covering, only 10% of positions have been covered. 40% of positions are still standing, and there is no big news as such which would lead to a big up move. Then you will see that short covering would fade and it would come down again. But if out of 50% of positions, if 40 or 50% of positions are covered, then there is a good chance that after short covering, you might see a follow-up long position only, and that can be termed as trend reversal. Now in this process, what would happen? You'll miss out on bottom formation.
Okay.
You'll miss out on, top formation. But that's okay. It's a hard work. You leave it for someone else.
Okay, all right, got that. Now you mentioned one very key line, how to read the derivatives data. Putting all of this data together, if I want to take a call on a particular stock and understand what's happening in the market, is it possible to read this data and then determine the trend? And if yes, how?
Yeah, so first we spoke about, some of the long formation, short formation. Let's consider, people's favorite Nifty and Bank Nifty, that how you should read data and try to interpret the direction, and same concept you can apply on stocks also. Every underlying has this data. Options data is very easy to understand. Now if we can, show the chart of options.
Yeah, it's there on
in
the
this
screen.
chart you can clearly see that depending upon strike prices, you have call open interest and put open interest. If everything is constant and IVs are decreasing, then it is selling of an option, and if everything is constant and IVs are increasing, it is buying of an option. That one factor we need to understand. And now look at, see at this chart. Here you are seeing that at 11,600, the bottom bar, maximum amount of put options are there. By the way, this data is hypothetical. It is not exact data of market. So
Sure.
it's just from education perspective, this data has been put. 11,600 has maximum number of put built up. That is seen in this chart. Most of the time what happens, that if people are very bullish and they are anticipating that this level is not supposed to be breached, they will write these put options, and which shows that this is support level for the market. If you look at calls, call concentration is around 12,200, which means people are not anticipating in this expiry market to go about 12,200, and hence they are writing call options. So this is one of the way of identifying support and resistances in market. Now this very important data apart from long form short formations is FIs data, and that data should be cleanly watched. FIs are more active than DIs in derivatives market at least, and what they do impacts market. Now this is what happened in this week. Monday market corrected substantially, and it bounced back on Tuesday. But in that bounce back, FIs formed short positions. If you can see on the chart on your screen, around 1100 crores of short formation in index futures, and this is with rise in open interest. Just seeing sell figure or a buy figure without seeing open interest is like shooting in dark.
Okay.
If it was long unwinding, then we don't read much, but it is formation of short position, so you have to see along with open interest. So these are some of the aspects of data reading which one should do to analyze market and its direction. Same way you can do for stocks also, for options, for futures as well.
Okay. So I have a couple of queries here before I go across to our viewer queries, and we're very short on time. If we can just go back to that earlier plate on the various options and how to sort those bars that had come through. I just want to understand that you're saying that okay, this is the plate, yeah. So at 11,600, there's a maximum amount of put open interest. Is it always true that if there's maximum amount of puts written there, means that is the floor for the market, that the traders don't expect the market to go below that? I mean, is that the easy way to read it?
So that's the easy way to read it, but provided if there might be, you have to see in line with IVs. So we skipped one slide where, in futures you see price and open interest. In options you have to see IV and open interest. So when this formation, put option formation was happening, at that point of time IV was decreasing, then fair enough, you can think that this is a support. But when this put formation was happening and IV was increasing, that means people were buying, then you should not consider this as a support.
Okay.
So these are some fine tunings which you have to do while you are researching.
All right, we don't have too much time. We could have gone on for a goodish bit, but I have a few queries, so I just want to take them. Mohit Jagwani writes into us, how do we hedge our existing positions in the F&O segment, and what are the various combinations of trade? What would your answer be?
So hedging comes at cost. It's very easy to say I'll hedge my portfolio and I'll be fine. There are two costs to hedging. First is opportunity lost. So suppose you have a portfolio, you calculate the beta of portfolio and go short in index of the corresponding beta and value. that locks your potential profit. Suppose if market doesn't correct, now people are expecting market to correct, and if there's a big move, then you will lose that move. There's no cost attached to it. And there are other ways of hedging where you keep your upside open. But as I said, nothing comes for free and there is a cost attached to it. So you have to buy options, you have to buy puts to hedge your portfolio, and that comes with cost. So if, say, market goes up substantially, what you lose is just the premium money which you have paid, and if market corrects substantially, then with that small cost, you have hedged your portfolio. But problem happens when you buy puts, they're expensive, and market doesn't go anywhere, your portfolio is also there, and you lose the hefty premium puts. So it's easier said than done, but you have to keep monitoring.
Okay, Siddarth, I'm sure you're going to get many questions and feedback and queries after this show because you've explained it to us beautifully, but unfortunately we've run out of time. Thank you so much for joining us. And personally, for me, I've never understood futures and options, so this was really a masterclass for me personally. But thanks a lot. I've sort of begun to go with the flow. With that, actually, it's a wrap on this episode of Smart Money. It's a wrap on a two-part series where we try to sort of demystify the entire futures and options space. Keep all your feedback and queries coming. Until then, you guys have a great weekend.
We all